Andrew Stentance is a lone voice at the Bank of England. For the past few months, he has been the only one of the Monetary Policy Committee's 9 members to vote consistently for a rise in interest rates. The cost of borrowing has never been lower, and yet inflation has remained stubbornly above the bank's 2% target. On the high street and in the housing market, there's conflicting evidence about the economy's direction. In a moment, I'll ask Mr. Stentance to explain his concerns. But first, here's Sky's business correspondent, Joel Hills.
Jeff, in the last 3 months of 2009, our economy came out of recession. And since then, the big question has been, how strong is the recovery? Andrew Stentance's view is that a double dip is not on the cards. Those are his words. But yesterday, I spoke to a former colleague of his, a former member of the Bank of England's Monetary Policy Committee, David Blanchflower. And his view is that Mr. Stentance is wrong and that raising interest rates, as Mr. Stentance is proposing, is the last thing the Bank of England should be doing. Economic forecasting is a bit of a mug's game, but some crystal balls do work better than others. David Blanchflower was one of the few credited with spotting the recession coming, and he believes that more action is needed to prevent the recovery running out of steam.
House prices are falling, GDP growth is slowing, so the latest evidence is that the claimant count rose this month, and the evidence from REC KPMG on hiring suggests that the rate of hiring is slowing. I absolutely don't rule out a double dip. I think the probabilities of it are rising daily.
The Bank of England's Monetary Policy Committee have kept interest rates at a record low of 0.5% for 18 months now. But the bank's primary objective is price stability, not economic growth. And at least one member of the 9-strong committee feels it's time to address inflation by raising rates. Andrew Stentance has looked into his crystal ball and decided that the outlook for world economic growth is good, that the recovery in the UK has momentum, and that as a result, now is the time to start normalising interest rates, not least to tackle inflation, which has been above target for much of the last 4 years. But David Blanchflower thinks he's got it wrong.
If you think about it, the argument that we should focus on inflation over the last 10 years and that would solve everything proved absolutely wrong. We were told if you focus just on inflation, then we couldn't have a recession. Well, we've just had one. So focusing on inflation is the wrong thing to focus on. We should be focusing on output. Inflation is not the great demon. We should just ignore it at the moment.
David Blanchflower and Andrew Stentance represent two ends of a debate which should interest us all. When interest rates do rise, servicing debt and borrowing will become more expensive.
Blanchflower says we shouldn't worry about inflation. He is probably right. I mean, it's very difficult in these circumstances to say whether someone's absolutely right or absolutely wrong. But inflation is above the target, well above the target of 2%. But it's not going higher, it's not feeding through into wages, and as we go forward, we're going to see special factors like another hike in VAT, which may send inflation up again, but won't send people's desire to push up wages and spend up again.
The policy response by the Bank of England and others helped prevent meltdown in the financial sector and arrested a slump in economic activity. But great uncertainty lies ahead. Interest rates will have to return to normal at some point, but it's unclear when that will happen and what level the new normal will be.
Well, Joel Hills joins me now live from just across the River Thames. Joel, good evening. Professor Blanchflower used to be one of the MPC. How much of a maverick is he regarded as by the economic establishment?
Well, I think he was a lone voice in the Monetary Policy Committee in the years leading up to the months and leading up to Lehman's. He was pushing, though, against, I suppose, the prevailing view, which was at the time that inflation, you remember the spike that we saw in prices, the inflation was the real problem. That said, he's not a prophet who always gets it right. In February last year, Jeff, you may recall, he suggested that unemployment could hit 3 million by Christmas and suggested too that economic growth was likely to remain negative throughout 2010. Neither of those things has come to pass. However, he has built up a head of credibility on account of the fact that many of the judgments he made in late 2007, early 2008 2008 seem to be, the warning signals that he spotted seem to be, with hindsight, absolutely on the nose and credible. And the point he's making is that what we've seen in the last few weeks is a weakening in the economic data, and to focus on inflation now, as he put it, would be a mistake. We'll get the minutes from the Monetary Policy Committee published tomorrow morning. We'll find out who and how people voted, but it is interesting to see just how many people share his view. Charlie Bean, Deputy Governor, gave a speech recently, Jeff, where he said didn't rule out further action, increasing, further loosening, if you like, of monetary policy. Mervyn King, the Governor, recently said that it would be a choppy recovery. It'd be interesting to see just how many of them shared Andrew Stentance's view and whether any of them voted for an interest rate rise at the last policy meeting.
Joel Hills, many thanks. Well, Andrew Stentance joins me now here at the Gherkin for an extended and exclusive interview. Andrew, nice to see you. Thanks for coming in. Clearly, you are worried about inflation. Your colleagues on the MPC appear either not to be worried or are less so. What is it that you know? What is it that you can see that the rest of them don't?
I think the basis of my view is that the policy settings we put in place, the very low interest rates of 0.5%, which is not just low in terms of recent history, it is after all the lowest interest rate the bank has set for over 300 years, was in a response to a very different economy from the one we now inhabit. There's clearly a lot of uncertainty around, and there's some headwinds like the government's fiscal policy. But in the middle of last year, we were really worried about the immediate effects of the financial crisis and the fact that the economy was contracting, and we had expected inflation to fall and possibly even turn into deflation. What we've seen since then is the beginnings of a recovery. It's a bit uneven, and we've seen inflation running above target. And I think on the basis of those two things, it's not the forecast, it's almost the way the economy has actually changed. Makes me believe we need to gradually, not in a dramatic way, gradually move interest rates up in a slow way, which will not destabilise business confidence, which is obviously very important to the recovery.
You know, Andrew, I have a theory about you, and it's this, that you are the only one on that MPC who has ever worked in industry. Of course, you worked for a long time for British Airways. The rest of them are either academics or central bankers or policy wonks. Does that affect the way you see something?
Certainly my business experience, I think, helps me and understand factors driving the economy. But it's the committee has a range of experience, and I think there's a range of factors that affect people's views. I think, though,
But nobody from industry apart from you?
Well, it's for the Chancellor to determine the composition of the committee, not for me. But certainly I am encouraged that we have seen some turnaround in business confidence, in business activity. And in particular, we've seen the strongest growth in manufacturing output over the last year that we've seen not just for a few years, but since the mid-1990s. So some of the indicators that I look at, which are based on what's happening in business, do show that the climate has changed quite significantly. Now, I don't think we should be hiking interest rates and pushing them up dramatically. I do think, however, we need to begin to move gradually in a way that won't upset business confidence away from such a low level of interest rates.
Give us a peek behind the curtain of the MPC. In recent months, has nobody apart from you said, look, guys, hang on a minute, we keep saying that inflation is going to go down. It doesn't. It's been above target for something like 40 of the last 50 months. We're getting this wrong.
Well, the bank sets out in the inflation report, which was produced last month in August, its analysis. And what is quite clear is there are a number of factors operating in the economy in different directions. There are clearly worries about the financial sector and about the fiscal headwinds. On the other hand, there are upward pressures from global commodity prices. We're now seeing food and cotton prices going up. There's upward pressure from the pound. And I think different members will put different weights on different factors. I think one of the issues that I would highlight, however, is that we haven't seen through this recession the same dampening impact on inflation that we've seen in previous recessions in the early 1980s and early 1990s. I think we need to learn from that, and it may mean that we won't see that dampening impact on the future, and I think that's one factor that's in the bank's forecast that I'm a bit more sceptical about.
Of course, a collapse in demand didn't always dampen inflation, did it? In the 70s, we had stagflation, demand going south, inflation going up.
And I think we do have to remember, listening to those comments from Professor Blanchflower, that the last time we let inflation get out of control in the UK, it took 25 years, 2.5 decades, to get the economy back on an even keel with low inflation, a satisfactory level of unemployment. So it's quite right that we have inflation as our broad objective.
Is that right? Because I've got a quote here from Professor Blanchflower. He wrote this recently. He said, we should simply, quote, reflate our debts away. And then he asked, what's so bad about inflation? Savers can protect themselves with index-linked products. You don't believe that, do you?
Well, there's two reasons why I don't agree with that. One is I don't think that that is a lesson of history, that you allow a little bit of inflation and then that suddenly turns out to be a bit more of inflation. If you see how the UK got a serious inflation problem between the late 60s and the mid-70s, that's what happened. But we have a statutory responsibility on the Monetary Policy Committee. We are required to account to Parliament and to the Chancellor on our ability to keep inflation on target. And so whatever our own personal views are, we have to try and keep the economy on a steady course in terms of inflation. But this is not in conflict, I should emphasise, with supporting the recovery and allowing the economy to grow. We had a decade and a half prior to the current financial crisis when the economy grew quite steadily and quite healthily with a reasonably low level of unemployment, with low inflation. And that's the sort of path we want to get back to, and that's the sort of path of growth and inflation that I'm trying to get the economy back to.
You see, what I don't understand about the reflationists, the boosterists, is this. If we look back to the causes and the start of the crunch, it wasn't because we had too little cheap money, was it? We had too much cheap money flooding the system. So how can it be now that yet more cheap money solves the problem?
Well, I think one of the things we've learned in the financial crisis is you can get big shocks to the economy that aren't related to the way in which we've run our economy in terms of growth and inflation. The financial crisis was a global shock. Its origins were in the US mortgage market, coupled with other global financial imbalances. And I think we need to be careful about using monetary policy to solve all the problems that we face in the economy. There's clearly a need to rebuild the financial sector and to get the financial sector on an even keel. But we also need to set interest rates with a view to what's going on in the rest of the economy as well.
Andrew, what about all that money that the Bank of England has printed, £200 billion worth? There are many people who believe that inflation is solely a monetary phenomenon, and for them, this eventually will lead to runaway inflation. Why won't that happen?
Well, it shouldn't happen if the Monetary Policy Committee withdraw the stimulus that provided by that big stock of money and low level of interest rates as we get evidence that the economy is improving and that the inflationary risks are beginning to turn to the upside. And that's the basis of my position. I don't want to withdraw that monetary stimulus very rapidly. I think we should start beginning to do that very gradually now.
And are you winning the debate? Because you were a lone voice. Is anyone listening to you?
Well, you'll have to see the minutes of the Monetary Policy Committee come out tomorrow, so I don't want to preempt that. But a lot of the arguments I'm making are reflected in those minutes. And obviously there's a very significant debate going on here. It's a matter of difficult judgment.
So you're not dismissed as bonkers?
I hope not. And I certainly find that there is a respect for my views on the Monetary Policy Committee and indeed in the outside world as well.
We can't wait to see those minutes tomorrow. Andrew, thanks very much. Let's return to my extended and exclusive conversation with one of the UK's most influential economic figures, Dr. Andrew Stentance. He's the only member of the Bank of England's Monetary Policy Committee to have voted recently for a rise in interest rates. What do you make of that news, Andrew? The Fed there saying that they're keeping interest rates as is, but they're prepared to take, what was it, additional steps to boost the economy. Of course, the economy is slowing in the States, and Professor Rubini, the Dr. Doom, he famously says the Fed's run out of bullets.
Well, I think we have to distinguish between unevenness for the rate of growth, which we often get at this stage of the economic cycle, and a genuine double-dip recession. And certainly in the case of the UK, I see that as not the main scenario, or even the global economy the main scenario. There has been some unevenness in growth in many economies. But in terms of the UK economy, I think we are on a recovery track, and the key question is how quickly that will proceed.
As an economist, you have to make certain assumptions about all sorts of things, but one of them surely has to be government fiscal policy, whether the government is spending more or spending less. As a forecaster, are you persuaded that the coalition will stick fast to all those proposed public spending cuts?
Well, we have to take the government's spending and tax plans as they're outlined, and we put them into the judgments that all Monetary Policy Committee members make in terms of their impact on the economy.
So you take them at face value. You're not saying to yourself quietly, they'll never see this through. It's all going to fall apart because there'll be too much public resistance.
And I think it's quite legitimate to do that. In the mid-1990s, we saw quite a big rebalancing of public finances of a not dissimilar type to what is in prospect now. It's quite right to keep government spending supportive of the economy during a recession. Then when the economy moves from recession to recovery, you have to begin to rebalance the economy. And in that rebalancing, I think the key thing to keep sight of is the private sector that will be the engine of growth. And there's some things that are quite favourable for the private sector. The pound is at a competitive level. That's very helpful for manufacturing industry. Interest rates are at a low level. And even though I'm arguing for some gradual increase, that's partly because I want to avoid a sort of larger increase further down the track, which could destabilise business confidence. So, interest rates, even if they began to gradually rise, would still be at a low level and supportive of recovery.
You're setting out a fairly warm outlook here, something that we could all live with. Explain to me this. Why, if the government does go ahead with all those spending cuts and the inevitable job losses that will follow, why won't that suppress demand and in itself crush inflation?
Well, it will have some impact on demand, but private sector demand is a much bigger component of our economy than the government demand. And in the 1990s, we found that private sector job creation outweighed any reduction that we saw in the public sector.
So do you believe that unemployment is not going to rise here? You think there will be a simultaneous balance, if I can put it that way, so as the public sector jobs are cut, the private sector will pick them all up? Surely not. We're talking about hundreds of thousands.
Over a period of time, I would expect unemployment to come down over the recovery, even though the government is rebalancing. Now, that doesn't mean it's going to necessarily not sort of rise in some months. As I said,
so
I expect the recovery
but in the short run, you expect unemployment to go up.
But the pace of public sector job reduction is still not very clear from the accounts that the government has given, and we've still got to see the results of the public spending review. But based on the numbers that Sir Alan Budd, when he was in charge of the Office for Budget Responsibility, came out with, I think there is sufficient vitality in the private sector to take up the slack. And I don't see why over a period of years unemployment shouldn't gradually come down over the recovery, with the private sector growing faster than the public sector is shedding jobs.
What about the wider world? What are the big impacts that you are encouraged by and perhaps frightened by?
Well, I think the big story for me in the wider global economy is the real engine of growth that's come out of the Asia-Pacific region. Obviously, economies like China and India, but even Japan.
But aren't we well
placed
here to take advantage of that? I keep reading that we're not.
Well, we do. If you add up all the economies in the Asia-Pacific region, yes, they are a significant export market for the UK. But we also benefit from the indirect effects. So the European Union is a major exporter to the Asia-Pacific region. So we just saw in the last quarter's figures, German growth was the strongest since unification. And the countries around Germany are clearly benefiting from buoyancy in the world economy. What we've learned through the period of the financial crisis is that we're in a very integrated world economy. And if there is strong growth in Asia, yes, it will spill over gradually and benefit our exports. But it also puts upward pressure on global commodity prices, such as oil prices. We've seen worries about food prices and other commodities. And so when we're setting monetary policy, we have to take both sides into account, both the benefits to growth and also the impacts on inflation.
Andrew Stentance, lovely to see you. Thanks for coming in.
Thank you.
Appreciate it.